right, well, welcome and good morning. It's great to be with all of you here today. Today's webinar, we are really focusing and zoning in, like Benny said, on the retirement target maps within Asset Map. And we're going to start off today by looking at an overview. So the fundamentals of the retirement target map, how it calculates, what are the defaults, what are the things to remember, and just work through those basics. Then we'll go through a couple of high-level examples of different scenarios in target map, retirement target map planning. I'm also going to work through target map preferences, so how you can set up your own preferences and defaults that you want to use that reflect your house view. And then we'll look at in-retirement modeling. So that's a question we get as well, not only for clients building up to retirement, but how do I model differently for clients that are already in retirement? So we're going to look at modeling for in-retirement clients. And then at the end, we'll have some questions and answers. As Benny mentioned, please post your questions on the chat or in the Q&A during the session. We will get to all of them. All right, so let's get started. Hey, Benny, I'm just checking you can see Asset Map now.
Yes, I can.
Perfect. Okay. So the first example we're going to look at is this family. This is the Kensingtons. So as you can see, we've got Cade Kensington, he's 45, his spouse Jessica, who's 40, and they've got two children, 16 and 14. And I just want to show you, we're now on this dashboard here on the left-hand side, and you can see on the dashboard who the members are. You can see Asset Map at the top here in the middle, as well as target maps on the right-hand side. So if we had built any target maps for this client, they'd be showing up here, but we can also create target maps from here on the top right-hand side. The other way of getting into the target map section is using this panel on the left. You can click on target maps here on the left-hand side, and you can also open this panel. So you can also look at each of these sections by opening the panel here or hovering over the icons on the left. So if we go into target maps, we haven't created one for this client as yet. I'm going to start by just giving you a bit of an overview of what we've created for the client. So the Kensingtons, they're both working, employed, earning an income. So you can see Kate's here and Jessica's on the right. They've both got retirement funds that they're contributing to through their employer. And they've got some discretionary investments in the form of shares and tax-free investments, as well as some risk benefits at the top and property and loans here at the bottom. But we're going to be focusing more on the investment side on the retirement target map. So first thing we're going to do is select new target map. And you'll see when we select that, there's certain templates that exist already. There's one for loss of life, disability, long-term care, or an illness, education, and retirement funding. We also have custom, and that gives you the ability to build a target map for any goal that a client may have, as well as recently released templates where you can build your own templates within Asset Map. But today we're focusing on this one over here, retirement funding. So if I select that, you'll see that retirement funding is the one target map that you can run for both spouses or partners together, as well as individually. So I can run it for Cade and Jessica together, or Cade by himself to see how funded he is, and Jessica by herself to see how funded she is. You could do one or the other, or a combination. Today, I'm going to focus on looking at the two of them together, how they're positioned and funded for retirement together. So I select both of them here, and then I select Create. Okay. So we'll immediately see when I create it, it comes with an outcome. So we can see at the top here, it's showing, in this case, quite favorable outcome of 80% funded. And we can see this bar at the top is in the color green. Retirement is always green. Loss of life is always blue. So each of those different templates have their own color. And here we can see that it's 80% funded. If I hover over that bar, we can see that that 80% is made up partly by assets, 70% of it, and partly by cash flows. We're going to go into that in a bit more detail now. The other thing I want to point out is at the bottom of the screen, Target Maps is split into 3 sections: what the client wants, what they have, and what it means, as well as the cash flow report here, which we'll go into in a bit more detail today as well. I'm going to start with what you want. So this section, I want you to think of as, what is this client's needs in retirement? What are the expenses that they're going to have that we need to ensure they're funded for? And as a default, you'll see that because of the defaults we've put into the model, it automatically assumes here that this client would like funding for living expenses, funding for travel, and funding for medical. Under the living expenses, it's assuming $450,000 a year that this client would need for living expenses from age 65 to age 100, escalating by inflation or cost of living adjustment, that's what COLA stands for, of 6%. Now, how does it calculate the 450,000? Because of the defaults we've put in, you can see here, it says 50% of the primary and spouse annual income. So essentially it's taking Cade's income, adding Jessica's income, and taking 50% of that. In addition, it looks at 10% for travel, which is this 90,000, and 10% for medical. So if you think of it as a total, we're looking at 70% replacement of income. The reason we split it into these three different sections is so that we could potentially have different start and end ages for these different needs, as well as different escalations or inflation against each of these needs. You can see medical, we've put up at about 8%, travel, ending at age 18. Now, obviously, not all clients have the same needs. Every client is unique, and their needs in retirement are going to be unique to them. This is purely just a starting point that we can then engage with the client to work out what exactly are their needs and how do we add that in. So, for example, on this first line item, the living expenses, perhaps in engagement with this client, they said, they would need a little bit more than 450,000. Perhaps they're thinking more along the lines of 600,000 a year that they would need for living expenses. I can simply update that amount. I could also update the ages and the escalation if required. Key thing to remember here, if you are updating the amount, is to look at the description, because if the client's reading the report, it's now not 50%. If they are the type of client that's going to calculate that, you want it to read correctly. So you can simply remove the brackets or rename the section specifically around what you want to call it. It could be retirement income need or income to cover expenses, whatever words the client will relate to the most. And then you can update it. In addition to that, you can also edit any of these line items. You may even want to exclude a line item, and to do that, you could simply untick it. By unticking it, it removes it from the calculation completely, but still giving you the ability to add it back in at some point in the future should you require that need. If you're never going to want to include it, you can always use this trash can on the right-hand side to delete a line item. And you can add any additional needs, above and beyond these three line items by adding a desired cash flow here. And I'm going to show you an example, because a question we get quite a lot is, what if the client has a once-off need at some point in retirement? So in other words, not a recurring cash flow need, but a once-off need. Then I can simply select add desired cash flow. I can select the most appropriate category. I'm going to look at a holiday. So I can type in holiday, put in the amount, say it's 150,000, and then put in if that amount needs to escalate from now until they need it. I'm going to say yes. We want to make sure it keeps up with inflation. And then very importantly, for a once-off need, you're only going to put in a start age, not an end age, because it's not a recurring need. So here I can say that they're planning on doing this at age 65 and create. And you'll see it adds that line item here at the bottom for that value at that age and keeping up with inflation. So the key here is to really design this what you want section to specifically what this client requires in retirement. What are the needs they have? How long are they going to need that for? And what sort of escalation do you want to allocate to each of them? How we then calculate it is to say, what is the total capital that this client would need today in order to be able to fund each of these line items for the period requested with the escalation? So this total capital needed today is saying this client would need 14 million, assuming a growth rate of 8% at the top here. they would need to invest 14 million today, growing at 8%. And if they did that, they would be 100% funded and could achieve each and every one of these cash flows here. So that's step one. Step two is to define, if this is what you want, what does the client have already? What can we put into this bucket that we can use to fund those needs for retirement? And this what you have section will show everything that you've entered into the asset map picture here at the top. So the first section, it shows all cash flows. Now, cash flows would be contributions the client's making to retirement funds, incomes that they may get in retirement, such as rental income or annuity income. So that's at the top here. The middle section, it'll show all the assets, any investments, property, assets that you've captured into asset map will all show here under the asset section, and the bottom will show any insurance that's been created for the client. So obviously retirement, we're just focusing on these two sections here. Under the assets available, we can see that the model automatically allocates or adds into the pot the retirement funds that the client has. So that's these two employer retirement funds, as well as the contributions that the client is still making from today till retirement. Those also need to be added into the pot for retirement. But at this point, I can also select any other investments that the client has to then allocate it again to the pot that's going to be used to fund those needs. A couple of things on this page. If you look here, we can see the asset value. If we think about tax in target maps, how we look at tax, say over the lifetime of the investment, there is going to be tax. What percentage do we want to assume is that we need to deduct? And that is what we call this lost to taxes column. Again, that is a field that can be edited, but it's taking the asset value less the tax and saying this is the value that we can add into the pot, the value less tax, that we can add in to the pot of what's available to fund the client's goals in retirement. Similarly, if we look at the contributions the client is still making, it's important here to look at the ages. So they're contributing from now till they're 65. And on the very last column here, you'll see the present value equivalent. Now, what that is calculating is it's saying this client is contributing 60,000 a year from now till 65. That is the equivalent of having 480,000 today invested at 8%. So we're working out what is the value of these contributions today so that we can work out the total present value equivalent here that we can compare with the present value required under the what you want section. So just to summarize that, what you want is going to say this is the capital we need invested at 8% to achieve all these goals. And under what you have, this is the present value equivalent of what we have today and what we've committed to contributing. Then if we move on to what does that mean, we can see it summarizes those two areas. So here we're summarizing, if this is everything you want, then you would need 14 million. If this is everything we're allocating towards the pot, that value is 8.9. The difference is shown at the top here. So here we can see the present value deficit is 5 million. What does that mean? It means this client would need an additional 5 million today invested at 8% for this bar to go from 64% funded to 100% funded. Here. And then I want to talk just a little bit about these three fields here. So we get a couple of questions on that. This 5 million is the deficit as at today. What that is saying is unless the client has 5 million in investments available that they can allocate to retirement, if they don't, they are going to need to save that up from now till retirement. And this is calculating how much would they need to save per month in order to be 100% funded by the time they retire. The second box here is looking at the annual increase of this contribution. So in other words, if I need 5 million, I have to contribute 25,000 a month if I assume that I'm going to increase that contribution by 6% per annum. If I change the 6%, so if I say, well, what if we started a bit lower, but we increase more, more specifically higher over time. If I then change that to 8%, you'll see this 5 million won't change, but the 25,000 is now reduced because I'm starting with 21,000, but increasing it at 8% per annum. Okay, put that back to 6. I can also alter the duration to see how much extra would I need to contribute if I wanted to save it up in a shorter period. Then I can change the duration to work out what this amount is. So this increase here is only relating to the additional contributions that would need to be made for the client to go from 64% funded to 100% funded. Okay. The next step, after we've gone through what the client wants, what they have, and what it means, there's also this cash flow report here on the right-hand side. Now, this cash flow report, the graph at the top, firstly, the bars here are showing exactly what the client wants. That what you want section, it's showing how the client's needs are changing over time. The green is showing how long the client can sustain that based on what we've put into the pot. Okay? And below that, you'll see a cash flow report. So I want to talk through this a little bit today, because we do get some questions around, what are these different things that you can expand and how do I read this report? So the first thing you can expand is the capital required. If I expand that, here we can see the different needs that I've set up for this client over time, and I can scroll down and see when they start coming off and showing what the client needs. So that's 600,000. We can see actually, with the increase of inflation, it's about 1.8 million when the client actually retires. So this report is showing in future value, year on year, the changes. I can also expand the capital available. So here it's going to show the contributions the client is making and whether that is changing or remaining the same over time. I can also expand the assets, and you'll see here it's bringing in those 2 retirement funds net of tax into the model. If we move along this first line, we can see that this net savings is the value of the assets we've allocated to the pots, as well as the contributions for the first year. And then we take that figure, add the 8% growth that we're assuming to get to the end of year balance for year 1. Each year, we then add the additional contributions and growth, and we can start to see here how this end of year balance is changing over time. Up until the client retires, then we start drawing from the pots, and we can see here how that end of year balance is impacted by that until at some point it turns negative and the client has run out of funding. And that's this point on the graph where the green is running out. Okay. So one thing about the cash flow report is we often get asked, can you include it in reporting? If I flip over to the reports tab here, you'll see under this target map section, you can include the cash flow report. And I'm very pleased to announce that over the next few weeks, that cash flow report will also include this graph that sits at the top of the screen. So I know that's something we've gotten a lot of requests for. It is being added, and you will be able to include that now in reporting going forward. Okay. All right, so that's just covering the basics of target maps, the retirement target map, and how it works. Now we come to the next step of, once you've created this current view or baseline view, how do we then start modeling different scenarios or options for the client? The first thing I want to show you is that right at the top here, you can change the name of the scenario. And it's always good to just start by calling this, the current or the baseline scenario of which we're going to work from to create different scenarios for the client. So we can start with that. We can also then clone the scenario. So you can see it changes the name there. On the top right, I can clone it. What that's going to do is create an exact copy. So they're identical, but now I can start to do something different in this additional scenario to show the client the impact of changes. And I'm going to work through each of the tabs to talk through the different things that you could edit or change in each one of these. So if we start with what you want, for example, here I could change some of the needs. We could even stagger the needs. So, a good example is we talk about in retirement, you've got your go-go years, you've got your slow-go or no-go years. You could have line items representing what the expenses will be in each of those times, stopping one at, say, age 80, and another one starting from 80 to 90, and then a third one from 90 to 100. You can also clone it. So to make it just a little bit easier, you can click the copy button. It'll then pop up with the additional line item that you can then edit the ages and the amount for. And this recently added, you can also reorder this section in an order that makes sense for you and the client. So in this example, I'm going to say, yes, they want 600,000, but that's going to be till age 90. And then perhaps from age 90 to 100, they're going to reduce that to, let's say, 500,000. Remember to always update the description. So I can say living expenses from age 90. And I can change this from age 90 to 100 and update to show the impact of that. So there you can see how you can split that up over time. In addition to that, under the what you have section, here you can start looking at what are the other investments that the client has that we could allocate towards this goal. We can also look at, employer these contributions. Is the client perhaps escalating that year on year? So let's say, for example, this client is increasing their contributions with their salary increases. I can open up this line item and I can put in that adjustment to show that this client is keeping these contributions updated with inflation each year, and update that and show again the impact of that. Update both. And then we can see that the model is going from 69% funded now to 71% funded and reducing the additional contribution required here. Another question we get asked quite a bit is, what if I want to bring in an asset or an investment at a later stage, or just a flow of funds? Good example would be the client says, I am going to be getting inheritance. It's about 2 million at a future date. I can, under assets, I can add a custom asset. So here I can call it inheritance. I can put in the amount as 2 million. And importantly, to put in what age to bring it in. So let's say we're going to bring it in by 60. And I can also select if this is a future value. So if that's not going to grow from now till then, I can tick that and create and bring in to show the impact of that inheritance. We can also now reorder the assets in this section. So that's also a new thing that's been added. So I can move that up so that when I report on this client, it has that and I can reorder it in the order that makes sense for me and the client. So those are some of the things we can do differently here. Key things to think about is what changes do we want to make under what you want, under what you have. Are there other investments we want to bring in? Perhaps in this case, the client says, yes, the shares are also for retirement. We can simply allocate it here and show the client the impact of that they're now 80% funded. We can also look at other options like targeting a different return for the clients. If we change that expected net return, what is the impact? And there we can see the client goes over 100% and they're 100% funded. What's great about showing it like this is I can then rename this scenario to proposed or agreed, or the scenario we're discussing with these options. I can also put notes in to just list anything that that we've changed in here so that the client can see this is the things that we're proposing in this proposed scenario. And then if I flip back to this page starts telling a story now. We can see the baseline and we can see with the changes how the client is going to be. You can also reorder this section so you can put it in an order that makes sense with the different scenarios that you create for the client. So this page actually starts to tell a story. This is where you're at the moment, but if we do this, look at the impact, because the real question we're trying to answer is how do we progress the clients across this bar? How do we get closer and closer to that 100% funded so that they can enjoy the retirement that they desire? Okay, so that's the fundamentals of the retirement target map with some of the new things that we've brought in over time. The other section I want to take you through now is what we call target map preferences. You'll remember that when we created the retirement target map, it started with 50% for living expenses, 10 for travel, 10 for medical. Those are all settings that you control, that you can edit and adjust to reflect your house view for the client. And you do that by clicking on your initials in the top right corner or your picture. If your picture is up here, click on that and select target map preferences. And here you can see that you can default the expected return from 8 to a different return if you prefer that as a starting point. Remember, these are all just starting point assumptions because you will work with the clients and unpack what their needs are. But as a starting point, you can change the expected return, you can change the retirement age, that it ends at 100. And new addition, you can also set what tab a target map opens on. So you'll recall that whenever you open a target map, it always starts with what it means. And the purpose for that is that if you're engaging with a client live, it starts with the summary of that target map. But if you prefer it to default and open on what you want, you can simply change that setting here as well. You can also change the assumptions for any of these. And if you click on retirement, here you can see the 50%, 10% for travel, 10 for medical, with the starting ages, end ages, and cost of living adjustments. So all of that can be edited by you and reflect your house view so that as you create a new target map for a client, it all shows the way you want it to. And then you can edit from there and make it specific for that client. Okay. The next scenario that I want to work through with you is for a client that is in retirement already. So we get asked about this, quite a bit. Say, if a client's retired already, they've got income from different sources, how do we model differently for those clients? So I want to take a look at this client is Carrie Jameson, and I'm just going to work through the different income sources she has. So we can see here on the left-hand side, she's got a living annuity. And we can see that she's currently drawing from that living annuity at $15,000 per month or $180,000 a year. But in addition to that, she's also got a guaranteed income from her life annuity of $60,000 a year, as well as rental income, let's assume guaranteed, of $60,000 a year. On the right-hand side, we can see she's also got unit trusts, share portfolios, some discretionary investments, and some property and risk benefits that we've mentioned at the top here. So the first question we need to ask ourselves for a client like this is, what are we trying to answer? What are we trying to show the client? And in this scenario, we know that these incomes are, somewhat guaranteed, but here we need to understand this additional funds that she's drawing to fund the $300,000. Are her investments that she has enough in that pot to sustain that additional income need? And that's what we're going to be looking at in the modeling. So if I flip over to target maps now, I've created one here, and under what you want, I've started with what the client is drawing today. And she's drawing $300,000 a year. She's 68 at the moment. We want to ensure that that lasts till 100. And she wants to escalate it or keep up with inflation. So that 300,000 needs to escalate with inflation each year. The question we're trying to answer is, does she have enough to fund that? So if I then flip over to what you have, now we can see here all the different income sources that she has, the life annuity, the rental income, what she is currently drawing from the living annuity, as well as the assets that she has, this living annuity, the unit trust investment, and the share portfolio. Now, the question I often get asked in this sort of scenario is, what do I select to include in the pot and what do we exclude from the pot? So the first thing I want to select here is the life annuity. That is a guaranteed income that the client is receiving from 68 to 100, and that can be used to fund some of that 300,000 that the client needs. So the first one we're going to select is that one. The rental income, we're also going to select. We're going to assume that the client continues getting that rental income, and that can also be used against the income required up until age 100. What we're not going to select, though, is the living annuity income. That the client is drawing from an asset, it's not guaranteed and needs to be managed. So we're not going to include that income. However, we are going to include the asset. And what this is going to show us is that if the client continues drawing 300,000, getting some from the rental income, some from the guaranteed annuity, and the rest from the living annuity, the pot of funds cannot sustain that. It's sitting at 64%. So now we can look at, well, she also has this unit trust investment and a share portfolio. If she starts drawing from those as well, does she have enough funds in that scenario to fund that income need? So if you see, if I select that here, we can see, across all of the assets, then yes, it is sustainable. If we need to exclude one of those because they're earmarked for another goal, then we'd exclude that. And then we can look at, different drawdowns over time, but we're trying to answer the question of, is the pot of funds enough to sustain that income need? Okay, so the difference between modeling post-retirement is really thinking about, what is the question I'm trying to answer? What is the need the client has? What incomes can we allocate because they're guaranteed? And what do we need to take from the pot of funds that's left? And in this case, these two are guaranteed, but the additional 15,000 needs to come out of the pot of funds that's left, which is this unit trust, share portfolio, and living annuity. And for that reason, those are the things that we're going to allocate under what you have: the life annuity, the rental income, and the different investments that the client needs to draw from. Okay. All right. Then one new addition before we open up for Q&A is on the Work That Matters site. We've added some standalone calculators there. You can see them here for estate planning. We are adding an additional calculator called the income tax calculator. It will calculate for a client very quickly, if this is their gross income, what would their net income be, after tax. But it will also calculate it the other way around. So if a client needs 30,000 Rand net in their pocket each month, you'll be able to work out, well, what gross income would that client need in order to receive that net in their pockets? That's a new calculator that we're adding to this list. Please send us your feedback on it. Let us know how that's working for you and any enhancements you think we can make as we add to this list. All right. Benny, I'm going to pass back over to you. Just open up for questions.
Awesome. Thank you, Kirsty. I was furiously typing away here. You cannot believe how many questions there were. So I'll try, and I hope I've got everything covered, but just to run through, Yolanda asked about the rental, how to treat rental income and rental property. So I think that was covered. There are a lot of questions on tax, and so Terence actually made the suggestion, maybe we just need to have a separate session on tax. I think this mindset of thinking about tax over the lifetime of a client is, I think it's strange. We tend to think of tax, like in the year of retirement or the current tax, and so thinking about it over the lifetime of the client is a weird topic. So I think we should deal with that separately. But if you've got any thoughts on that, how did you make the transition? Maybe that's the simplest question, because I struggled. How do you make that? How do you find the transition?
Yeah, I think tax is a broad topic, and you can go again down that rabbit hole as well of different taxes and when is it. I think for me the shift came to say, what are we trying to achieve? What we're trying to do is open up a conversation with the client, engage with them, where they can very simply and easily see, where am I now? And what do I need to do differently to progress across this far? And I find if we get too stuck in the detail of, this tax versus that tax, then we lose the client and lose that conversation, which is really these target maps. Of course, you can go into detailed tax planning separately as well. And in some instances, you need to, and you have to at that point. What these are trying to show is very, very simply for a client to easily understand, feel empowered, and engage on, where are you today? How far along this bar are you today? And what can we do differently to move you across this bar? So I agree that you can be more specific with the tax, and it's at different points in time, but this is doing something a little bit different and saying, let's show it to a client in the simplest way of, where are you today, and what are the decisions that you can control? Because the tax might be 30%, it might be 24%, but what we don't know what that's going to be over time. What we do know is that based on an assumption that we're making today, you're 64%. So you're not quite where you need to be. What are the things that we can do differently now? And I think it's in that, how do we express that to the clients? You know, we often talk about that quote, Benny, that said, you know, I'm sorry, this letter is so long. I didn't have the time to make it shorter. That's what target maths is trying to achieve. How do we take that detail but make it shorter, make it simple for the clients? They can quickly see, okay, if I do this, I move across the bar. If I do that, I move back from the bar, you know, and how do we progress you to be 100% funded?
And then the next rabbit hole is you know, two questions on, or maybe it's even three, but let's say two questions on sustainability of drawdowns, and how does the system work that out, and all of that. So in fact, we had a conversation about it yesterday, and I mean, that is a major topic, completely separate on its own. You know, when one starts thinking about what are the critical factors that goes into working out whether a client's drawings will be sustainable in retirement. And of course, the biggest one, which we keep on forgetting, is how long the client's going to live. And it's, I mean, we were speaking to an actuary yesterday, and in fact, I can be transparent. We spoke to Just Retirement, or Just Retire, yesterday. And it's fascinating how they think about that risk, and they talk to it. So maybe we need to do a separate session on that, Kirsty. But yeah, without going down the rabbit hole, maybe just exactly, if you could just say how you think about this rabbit hole of sustaining the funding in retirement.
And I think that there's layers to it, and the depth you go in depends on where the client is in that journey. And there will be different tools at different points in time that you'll use to go into that depth with the client. I think what we're trying to show here is just very simply, if this is the pot of funds and that's what you want to draw, it's yes or no. You're far away from it, or you're close to that, and it's going to come down to the strategy we employ. So I think these tools are, you know, trying to be very high level in showing a client just the impact of the decisions they make. What are the changes they can make that help them progress forward? So in the case of in retirement, as an example, it's about saying to the client, it isn't sustainable. We need to reduce the income. Now, we can do all the tools, and we know that that is the end outcome, that the client needs to reduce the income. But how do we reflect that to a client in a way that that makes sense to them, that they can say, okay, that makes sense. I need to do something different, or, you know, we need to have a different strategy around that. So these are the tools you're going to use to reflect to the client, to show them, you know, based on what we know from our planning background or from the different tools that we've used, this is the outcome, and let's reflect it in a way that the client feels empowered to make a different decision.
Yeah, I love that point, Kirsty. I mean, what you're saying is we also have to look at these numbers as professionals and say, where do we think, listen, if we see a problem case, you know, the client does not have enough funding. I mean, then we definitely, I mean, it's very different looking at it like a 20% funding level versus 89% level funding. And I think the reality is when you in the sort of, you know, close to 100, you know, then it's fine tuning. And you know, whereas if the client is materially unfunded, then we've got to think really long and hard about you know, the strategies that's available to this client, which could be outside of their actual their own finances, and relying on somebody else's funding. But yeah, so I think that materiality, or the sensitivity to the modeling of specific factors, I think is absolutely critical. And that we can share that in a simple way with the client. Say, listen, we're placing a huge reliance on your savings to retirement, or we're placing a huge reliance on there being very low tax, or whatever those things are. So yeah, so that's a great answer, Kirsty. I think that those are the main things. But what it sounded like is we need to have more sessions on specialist areas, tax, sustainability. And in fact, we've got an upcoming webinar that we're planning on. It's not quite on the modeling, but on this thing about clients unfortunately, it's a reality where clients get dementia, or they've got a reduced capacity to make decisions as they get older. And I mean, it's not a calculation issue, but I mean, that's a very specialist area in its own right. So yeah, so I think that the what I'm hearing from the audience is we need to go into more of those specialist areas. Yeah, and then thank you, Kirsty. Sorry, do you want to add anything to that?
Just one last point I want to add is to say, we often know the steps the client needs to take to move forward. We know it by looking at the map, looking at the picture, but think of target maps as a way of illustrating that to the client. So this is to illustrate how they can move forward, whether that's reducing their income that they're drawing or saving more if they're pre-retirement. Target maps is about the easiest way to illustrate to a client what we know is the steps they need to take to move forward. And I'll leave it there.
Awesome. And then well done on that. Those three. I mean, the little news. I don't know if people picked that up in the presentation. We've got a new calculator to do a pre to post, or post tax to pre-tax. It's the weirdest thing, but you know how hard it is to work out. If the client says, I want 20,000 Rand after tax, what is that pre-tax amount? So Kirsty's done an awesome job to build something to make that really simple. So we'll be sharing that calculator. I think Terence was also commenting, I love the hands where you can move the stuff up and down, use that in a client conversation to focus the attention on what are the important things, put the important things at the top, change the descriptions. I mean, that's awesome. And yeah, including the graph in the report. I think that's going to be awesome, especially for those slightly more detail orientated clients that wants a bit more analytics. Yes. All right. Well, and there was a few other questions. Not a few. One other question, Philip's asking about, just modeling asset allocation and investment returns for separate investments within the portfolio. But I think Philip will speak to you about that separately. I mean, there are specialist ways to deal with investment allocations. All right, so we'll do that. All right, so let's end it there. Thanks, everyone. We'll be sharing the recording, and yeah, we really appreciate this community, how engaging you are, and just the level of questions, and it's fantastic. So thanks to everyone.
Thanks, everyone. Bye.